Hey everybody, Marty Missouri, good morning. It's the 27th of October, 2016. Hopefully a quick commentary for you. This morning I'm going to talk about the kind of the short-term look of the market, and I want to talk about the health of the consumer and show you what I'm seeing in the data that to some extent is opposed or in opposition to some of the things we're hearing in the media and from analysts. But anyway, to begin with, the S&P 500 daily chart, this goes back a year. Here is the Brexit low. Again, I've shown you this lots of times, and I'll talk about the green line in a moment. Here is the Friday after the vote. Here's the Monday. Brexit kind of cleared the way to go through all-time highs that we were stubbornly unable to breach, if you will, from last May. Got above that, and I've told you a lot about this line of, I made it a big orange line, this line of what was really tough resistance for the market for quite some time. Multiple fails right there, which means people who trade the charts did well to sell that level. I promise you, a lot of people sold that level and regretted it here immensely. And then typically when you break through what was strong resistance, the longer you stay above it, the more likely it becomes strong support. People who missed out had great regret for selling here, and they're just praying for an opportunity to be able to get back in and ride what may be a new wave of the bull market. You can see we dipped a little bit below it there. I've been talking about 2100 as a maybe even a line in the sand for the market. So we'll see. 2120 has been very strong support. So if I were a short-term trader, I'd probably be holding my powder perhaps and maybe looking for something around the election or the Fed to give me an opportunity here. So I think a lot of people are waiting for that. We're not seeing huge volume, kind of a sideways, looks like a consolidation phase to me in the market, but I'll keep you posted on the technicals. Now, the green line is the sentiment, the bullish sentiment indicator among the weekly American Association of Individual Investors survey. You may recall, those of you who've been keeping up with me on these videos, before the Brexit, I was talking about the fact that sentiment was declining rapidly. And the point I've made for years is it's tough for the market to really come down in a big way when the majority of people are feeling bearish, meaning lots and lots of people fear losing, therefore a lot of them are on the sidelines. There's, in fact, let me just real quickly go over another big headline from just a couple days ago. This is mutual fund cash levels jumped toward levels not seen since September 2011. So a lot of pessimism among individuals, and as I just showed you, among professional money managers. When there's a great deal of fear, and when suddenly, as with Brexit, you realize that the event either didn't happen or isn't going to end the world, suddenly these people panic and realize that they're on the wrong side of the boat, therefore they run in. So this supports kind of my idea that the short term doesn't really look so bad for the market. I recognize that we have concerns over the election, that we have concerns over a Fed rate increase, and we could very easily, well, maybe not so easily, but we could definitely penetrate these markets or these levels. The market can do anything, absolutely anything on a short-term basis. So what we look at here is just probabilities, but clearly we are in, and this is just the daily chart, but if I ran the weekly chart, it would support it as well. We are in a nice looking upward pattern, and you notice how we've come right down on that trend line and continue to keep climbing. But I suspect we do break down below that and test this support again, perhaps a few more times as we move forward. I could certainly see some catalysts. Okay, so let's look at a couple of things. Yesterday, Lowe's was downgraded. Lowe's Home Improvements. Here's just a snippet from JP Morgan's commentary. The consumer environment has become increasingly difficult, wrote the analyst in a note to clients. Downgraded Lowe's stock to neutral from overweight and gave it a price target of 72, down from the previous target of 87. We believe an uneven consumer environment, difficult comparisons ahead, and so forth make for a challenging environment in 2017. I'm fine with that. There was the consumer confidence report from the conference board for last month was down a bit. But there's conflicting data. Let me show you this morning's headline from Bloomberg's weekly sentiment survey. Consumer sentiment climbed last week by the most since January of 15 on one of the biggest gains ever recorded for Americans' attitude about the economy. So that, of course, flies in the face of the analysts who downgraded Lowe's yesterday. So here's a look at the latest data on wage growth. Overall median wage growth has accelerated back to its highest pace of the expansion. In real terms, median wages are growing faster than almost 95% of prior occurrences. Full-time employee median wages surged 3.9% year over year. Women have made up ground and so on. So folks, this is a picture that actually bodes well for the consumer going forward. And for more of a maybe a macro longer term look, take a look at household net worth. The latest number is above all-time highs. One thing for sure, while governments have ramped up the debt on their balance sheets, consumers have substantially deleveraged. Therefore, the consumer right now in America is wealthier than he or she have ever been. And I think a striking data point is this one. This is the debt service ratio versus discretionary income. Here we were prior to the last recession. So anybody who suggests that the consumer in the U.S. is heavily strained, that the outlook is sketchy, questionable, negative, I'm telling you folks, the data that I'm looking at, even the recent sentiment data, and as I've already shown you, the wages data, just really doesn't support that notion. And just in terms of housing in general, which is an area of the market I remain somewhat committed to in client portfolios, take a look at some of the data. Here's just a chart from a great research firm that I subscribe to. Builders that sell homes before they're constructed have little risk of cancellation. Shown below in the chart, year-over-year changes in the path of homes sold without yet being built a few months ago in advance of the year-over-year change in charts. Assuming the sales figures remain anything close to their current pace of growth, starts are actually due to pick up. So there's that surge. And when you look at the median price, we know that home values are going up or home prices are going up. But look at the months of supply. It's very, very low. Commentary from Bespoke, this research firm, is shown in our second chart at Less's. Median prices surged almost 5% month over month, driven by a recovery in the share of the market devoted to homes over $300,000 in value. Inventories aren't at impossible tight levels, but fell from 4.9 months to 4.8 months. That represents no significant overhang for builders versus still strong demand. The demand picture is also evident in the number of months new homes spend on the market. That figure, the median, fell from 3.2 to 3.1 months in the release of September data. As shown, that's for all intents and purposes an all-time low. In other words, builders are having a very easy time selling homes that are placed up for sale, a signal that demand remains robust relative to supply. So folks, my message today is the consumer, and this is a segue from what I've been talking about lately. I've been talking about materials and the potential for infrastructure and why we want to own industrial stocks, etc. But the consumer, you know, the 2/3 of the U.S. economy in terms of consumer spending, other than his and her sentiment about stocks going forward, which is actually bullish for the stock market, is not something that we should be losing sleep over, at least at the moment. Folks, let me close with this. I have to be careful as the advisor to many of you, and as a commentator about markets and so forth. Meaning, when I look at the data, I have to look at it for what it truly is and bring to you the true message that it's sending. And I recognize that there's a lot of pessimism out there. That's a good thing, as I keep saying, for the market. Of course, it makes sense given that we're in an election season. But the data isn't telling me right now that we need to worry tremendously about what's to come. And I'll probably show you, I think maybe in the weekend commentary, I'll give you kind of a technical look of right now versus where we were a year ago, right before a pending Fed rate increase. And that's a different look than we had last year as well. Thank you, folks, as always, for watching and listening. And I'll talk to you again very soon. Take care.